Today we're looking at a company that's almost living a double life, Oil India Limited. On one hand, you've got this super profitable old-school oil driller, a real legacy giant. But on the other hand, it's also this ambitious builder, spending billions and billions to create a completely different future for itself. And right now, these two identities are in a tug-of-war, creating a fascinating puzzle for anyone watching. So, let's dive in.
And this brings us to the real head-scratcher, the core question of this whole story. Oil India is pumping more oil and gas than it ever has in its entire history. So logically, you'd think its profits would be through the roof, right? Well, they're not. They're actually going down. How is that even possible? To figure this out, we've got to unpack the company's two competing stories.
First up, let's talk about the company as it is right now, the driller. This is the established, powerful, and until pretty recently, incredibly profitable heart of Oil India. This is the company everyone has known for decades.
And believe me, this driller is performing at its absolute peak. In fiscal year 2025, Oil India hit its highest ever production of what's called oil and oil equivalent gas, a whopping 6.71 million metric tons. I mean, that's a record-breaking year by any measure.
All that record production? Yeah, that turned into a mountain of cash. For that same time frame, the company posted a consolidated net profit of over 7,000 crore rupees. We're talking almost $1 billion here. It's a staggering figure that just shows you the sheer power of its current operations.
But this is the number that really tells the story of efficiency. On a standalone basis, just its core business, Oil India hit a profit margin of over 27%. That is an insanely high number. Doesn't matter what industry you're in. It shows just how profitable the business of just drilling for oil really is for them.
So what's the secret sauce? How are they so profitable? Well, it's not some risky new venture. It comes from old, reliable, legacy oil fields. The wells, the pipes, the whole infrastructure, it's been paid for a long time. That means the cost to get a barrel of oil out of the ground is super low. It's basically a cash-generating machine. But that's only half the story, right? Now let's meet the other character in this play, the builder. See, Oil India knows the world is changing. It's making a massive bet on becoming a totally different kind of company, a diversified, integrated energy company, not just a driller. This is their blueprint for tomorrow. And the absolute centerpiece of this entire transformation is the Numaligarh refinery. Oil India is pouring money into a project to triple its capacity. And we're not just talking about a minor upgrade. They are turning a standard refinery into a massive integrated energy hub that's also going to pump out high-value petrochemicals. And this isn't just one project. It's a whole strategic pivot away from what they've always been. Step 1, triple that refinery capacity. Step 2, build a brand new petrochemical plant so they can get more value out of every single barrel. And step 3, at the same time, scale up their renewable energy portfolio. They're literally trying to change their own DNA. But a future this ambitious comes with a really steep price tag. And that price is being paid by the profitable company of today. All this massive spending on construction is putting a serious squeeze on the company's current financials. And of course, this squeeze happened at pretty much the worst possible time. Just as Oil India was spending billions, an outside force slammed into its core business. The price it could get for its crude oil just tanked, dropping by 15% in a single year. It went from almost $74 a barrel down to less than $63.
And there it is. That's the solution to our puzzle from the beginning. Think about it. The company was producing more oil than ever, but it was getting paid 15% less for every single barrel it sold. That price drop completely wiped out all the gains from their record production, and it's why their net profit actually fell by over 10%.
So, with profits falling, how is Oil India paying for all these huge construction projects? Well, by taking on debt. A lot of it. In just 1 year, the company's long-term debt shot up by a jaw-dropping 44% as it borrowed to build its future.
And this is so crucial. You can see the impact this is having on the numbers investors watch. Things like return on capital employed, which is basically how much profit you're making for every dollar you've invested, have been cut in half. And why? Because the company has billions of dollars tied up in things like that half-built refinery. These assets are on the books, but they aren't generating a single rupee in profit yet. It's a huge investment that won't pay off for years to come.
Honestly, this is the best way to think about it. Imagine a family that suddenly stops saving as much money each month. On paper, it looks bad, right? But it's because they're spending every spare penny building their dream home. They're not losing money, they're just converting their cash into a really valuable asset. That is exactly what Oil India is doing right now.
So that brings us to the big picture, the investment thesis here. This whole situation is one massive bet. A bet that the future builder version of the company is going to be way more valuable than the current driller version that the market is looking at today.
And to understand that bet, you have to get this concept of intrinsic value. It's not about what a company is earning today, it's about its true underlying worth based on all the cash it's expected to make in the future. Analysts are trying to calculate the value of that dream house before the paint is even dry.
And when they run their calculations, this is what they see. The folks who are looking at that future potential, they see a gap. They believe the company's true worth, its intrinsic value, is a good bit higher than its current stock price. They're suggesting there's a bunch of untapped value there that the market just isn't seeing yet.
So, let's put it all together. The argument goes like this. The market today is still valuing the old, reliable driller. It's underappreciating the huge, ambitious builder. And the key to unlocking all that future value is that New Maglau refinery expansion. For an investor, that gap between today's price and tomorrow's potential, well, that creates what they call a margin of safety.
So Oil India is right in the middle of this massive, company-defining transformation. They're gambling the steady profits of today on a bold vision for tomorrow. It's a massive bet that the future builder will be worth so much more than the present driller. The only question is, when it's all said and done, who is going to be the one to cash in on this massive gamble?